Hello and welcome to the Open the Gates Q1 2026 UK property market update, where I'm going to be talking all things Q1. We're also going to be touching on the March data because there has obviously been the conflict in the Middle East, which would have impacted things over the final month of Q1. So let's jump straight into it and start, as usual, with this update. So, for anyone new watching this from left to right, we have Q1 2026 versus the previous quarter of Q4 25. Middle column is year on year Q1 26 versus Q1 25. And the right hand column is Q1 26 versus the Q1 average of recent years. So, on the market, in terms of properties for sale, stock levels have risen steadily quarter on quarter and year on year, but they are still significantly up on the 21-26 average at almost 19%. So I say this probably every time I record these, but more stock equals more competition for sellers, more choice for buyers, which means that you've got to price property correctly and market it properly if you're going to get sold in this market. New listings were up a whopping 45% on Q4, which is unsurprising there because obviously Q4 is a quieter time of year. And then we also had the autumn budget uncertainty that then rolled straight into Christmas. There's not going to be really any surprises there. Up almost 5% on a year ago, which is positive to see, particularly considering that January, February last year, sellers might have been coming to market to try and beat the stamp duty rush and entice buyers, and then up a whopping 11.2% year on year as well. So it shows that there is definitely sellers in the market right now. They're confident to come to market, even with the final month of Q1, with all the uncertainty over the conflict in the Middle East and rising interest rates. In terms of sales agreed, again, unsurprisingly, up almost 17.5% on the previous quarter, down 2.6% versus Q1 25. So just to touch on that, if we look at a potential drop off in the final month of Q1 with the conflict in the Middle East, and if we look at January and February of 2025, that would have been a very, very strong couple of months due to buyers trying to beat a stamp duty deadline. And we're only 1.7% down on the 21 to 26 average. If you say to me before looking at the figures that year on year sales agreed would be only 2.6% down on last year, I would have bit your hand off on that. So I think that's a really, really good result. If we look at the 21-26 as a whole, 21-22 would have been booming market, 23-24 would have been difficult following the double-digit inflation, rising interest rates, and the hangover of the mini budget of the autumn 22. 25 would have been booming again with the stamp duty deadline, and then 26 pretty normal, although obviously March had to contend with the conflict in the Middle East. In terms of price changes, up a whopping 25.5% on the previous quarter. Unsurprisingly, more sellers taking action in Q1, up 1.6% on a year ago. So not massively, but price reductions still happening in the market, but up a whopping 29.5% on the 21-26 average. So it shows there are lots of price alterations happening in the market. I probably say this every time, but this is whether you're a glass half full or a glass half empty. There is clearly too much overvaluing going on from sellers and estate agents alike, hence why there are more price reductions happening. Property is staying on the market for longer. There is more stock available. Affordability is being stretched with interest rate rises, and that would explain the mismatch between what a buyer is willing to pay and seller expectations. But the glass half full is saying, great, those sellers are reacting to the market. And that is pointed out in the next metric, which is withdrawn data. So rather than just properties coming off the market, if they don't get their price, they're adjusting accordingly. So 24% less withdrawals versus Q4. Probably would have been quite a few withdrawals in Q4 due to the uncertainty over the budget. Lots of sellers would have gone, "Do you know what, this ain't for me, we'll go again next year." Down 12.5% on last year. There might have been a fair few withdrawn properties in Q1 last year for those sellers who realised they weren't going to sell and beat the stamp duty deadline. and only 2.3% down on the 21-26 average. Fall throughs are up 3.5% versus the previous quarter. Unsurprisingly, as there's been more sales agreed, down 11% on last year. Again, less sales agreed, and down just 2% on the 21-26 average. Again, not unsurprising considering there's been less sales. Fall throughs tend to just be consistent throughout. You typically see 25 to 30% of sales fall through. The quicker you sell a property, if it doesn't have a price reduction, the more likely it is to complete. But also a big fan of reservation agreements. You've then got things like auction. Shout out to Dan Firth and the team at Bid if you want to check out auction as an option. And then just getting a seller legally prepared at the start, getting searches applied for, getting a buyer to invest money sooner rather than later in a transaction, you're going to reduce those fall through rates. And then relisted across the board, down 5.5% versus a year ago. So less sellers returning to market as it stands. Sorry, and that's on the previous quarter, should I say? And then down a whopping 54% versus a year ago, and then 43.5% on the 21-26 average. So I'm going to say there are plenty of sellers out there who perhaps could be enticed to come back to market if you know how to target them. 29% of properties currently selling are doing so with the second agent. I say it all the time, but withdrawn, withdrawn, withdrawn. Please do target those properties. And if you want some insights onto the best ways of doing that, please do reach out to me. Now, I'm just going to quickly run through, whilst this won't be on the main screen, I'm going to run through some March data that I have also collated as well, just to run through how the final month of Q1 performed before moving on to pricing. So in terms of properties for sale, they're up 5% month on month and 19% year on year. New listings were up 16.5% month on month. Month on month and 8% versus the 21-26 average. Sales agreed were down 1.4% year on year, but still 6.4% up month on month, and down 7% on the 21-26 average. So it shows that actually there have been some sales agreed in March, but a little bit lower than the 21-26 average, which is not unsurprising there. Just quickly on this, I was thinking about this yesterday in terms of transaction levels in this country, and this is back of Fag Packet. 750,000 transactions means the world is ending, 2008. A million transactions is a very average market. Think mini budget. 1.25 million transactions is a good market. Think 2025. And then 1.5 million plus transactions is a booming market. Think 2021. So you've got a variance of 750 to 1.5 million. And what you'll find as I go through this recording, Zoopla are talking about there definitely still being demand in the market. It's just from those who need to move rather than those who want to move. So it's figuring out who those buyers are and acting on that. Right, back to March data. Price reductions up 5.5% year on year, 23.5% month on month, and 33.5% on the 21-26 March average. So plenty of price reductions happening. Withdrawal numbers are down on all metrics, which shows that sellers were not withdrawn from the market in March with all the conflict going on in the Middle East. Fall throughs were down year on year and the 21-26 average. They had increased a little bit on February, 8.5%, which makes sense because some buyers maybe got a little bit nervous of rising interest rates, maybe mortgage offers weren't there, products got pulled, etc. And then relisting numbers down almost 50% year on year and 36% on the 21-26 average. But versus February, they're actually up 30.5%. So perhaps that does show there are some sellers coming back to the market slowly but surely. Right, so let me just get ready on my other screen for price changes. Here we go. Right, so average asking price on new listings. So a year ago it was at 423, now stands at 425.5, and previous quarter was 408. In terms of percentage changes, versus the previous quarter, up 4.3% and up 0.6% year on year. So it shows that there's some steady growth in the market in terms of average asking price of new listings. On the pounds per square foot, it's gone from 378 to 402 year on year, and then was 383 in the middle. In terms of pounds per square foot, that is 5% up on the previous quarter and 6.3% up year on year. So that suggests that the average asking price of properties coming to market, whilst it has gone up a little bit, the pounds per square foot has increased more, which would suggest prices have risen. It's lower end properties that have been more likely to come to market. And then on the sales agreed, average asking price was 356 a year ago, pretty much identical at 356 right now, and slightly down to 357 of the previous quarter. So in terms of comparing it to the previous quarter, down 0.3% and then steady versus a year ago, which basically says prices haven't moved anywhere on that point. And then on the pounds per square foot, it's quite a similar story as well. So a year ago at 342, currently at 348, and then previous quarter is 345. So pounds per square foot versus previous quarter up 0.9%, and then versus a year ago up 1.8%. So it just shows that there is steady growth in the market as affordability improved, house price to earning ratios improved, inflation came down, interest rates improved. That meant there was a little bit of growth in the market. Those price gains are perhaps going to get eroded by the uncertainty through the Middle East conflict and rising interest rates. But obviously, we'll see more as we go along into the next couple of months. Okay, on to mortgage approvals. Um, Mortgage approvals were 62,500 in February. That was up 4.5% on the 60,000 recorded in January, which shows that mortgages were moving in the right direction. They are down 1.3% on the 12-month average and 5% down on the 10-year average. So again, nothing terribly bad there, slightly down overall. It'll be interesting to see what the March data is at the end of April when that comes out, as that's going to be the full month of the conflict going on. It'll also be interesting to see how that goes into April as well. And then transaction numbers. Transaction numbers were just over 102,000 in February, which was 5.5% down on last year. But as you can see from the trending line, February and March was busy due to the stamp duty deadline. Month on month, they were up 8.2% on January, which was really positive to see. Up 2.5% on the 12-month average, again positive to see, and only 0.6% down on the 10-year February average. Now, in terms of the full month as well, February transactions were the highest they'd actually been since March 25 with the stamp duty deadline to be hit. So actually some positive news there. So all in all, looking at those mortgage approvals and transaction numbers, it shows that we're not a million miles away from what's kind of been the normal of recent times. You're finding that depending on what is happening with consumer confidence, we're typically going a few percent either way. So a few percent higher as consumer confidence rises. And if we get anything negative in the news, that drops it down a little bit. But if we can stick within that 5% region, I would say either side, you know you're in a pretty good market. It's the estate agent's job to then find out who are those wanting to move in this market and then who actually has a need to move. And then that's where you're going to be doing business moving forward this year. Right. Inflation. So I just look at my other screen. So inflation was 3% in March. So moving in the right direction, but it is remaining a little bit sticky. It is positive to see though that remember we were double digit inflation in late 22, early 23. So a lot better than what it was. But that stickier inflation is probably going to be even stickier with the conflict in the Middle East as oil prices rise, and then that's going to hit everyone when it comes to their shopping basket in a variety of different ways. That could then impact interest rates. If we look at where interest rates have gone over the past month, the cut to interest rates observed over the past year, give or take, have pretty much been wiped out. But just remember on that a year ago, when interest rates were at the level they are now, people were still doing business. So there's definitely still some transactions to happen. And then the Q1 2026 house price index update. 0.18% monthly rise as an average, and then 1.18% as an annual. As I've said previously in this recording, there's been modest house price growth. There are several different metrics looking at here from prices on new listings. Some are on sale agreed, some is on mortgage data, some is on completed data, and that's why I've combined these all together so you get an understanding of all the different ones. So, looking at that before we jump into the house price index updates, I think it's all things considered, market is performing. It's resilient, as I typically say, and there are people out there who want to move home. It's just making sure we're having the right conversation with people, letting them know not to not to panic. A couple of words I use a lot, perma-crisis and poly-crisis. We have been in a permanent state of crisis for over 15 years now, and each crisis we go to from one to another heightens the next one. So from recession, Brexit, COVID, double-digit inflation, war in Ukraine, war in the Middle East. We've had all of that to contend with. But if you look at house price growth, transaction numbers, just shows that the UK property market is incredibly resilient. Right, on to the house price index updates. Let's just zoom in on this. So Rightmove reported prices were up 0.8% in March, typical for this time of year. Sales agreed just 2% below the strong market of 25 already touched on, 5% ahead of 2024. So comparing like for like with 24 when there wasn't anything strange happening or indifferent to the market, shows that market has been pretty steady. Um, Rightmove report the average interest rates rising as well. So number of new listings coming to market is 3% behind last year, but it's still 7% above 2024, which is good to see. And then if I scroll down, I want to show this bit. So we had the unusual flat month in February for asking prices. The return of monthly price growth reflects the start of the spring stone season, but the pace of growth remains modest in line with the average of the last 20 years, but lower than the last two. Number of homes for sale remains a key factor, limiting more significant price growth, as I said, with an 11-year high of supply, and that's giving buyers more choice and then forcing new sellers to be more restrained on their pricing, being realistic, and that's where better marketing is going to need to come into play as well. And then competition to find a buyer is fierce, which has led to the longest time to find a buyer at this time of year since 2013. So that sounds a bit negative, but it just goes to show what we need to be saying to sellers about how they should be navigating the market. We're not in a market where you can just whack it online and hope for the best. You need a brilliant agent to help you navigate this market. And then if I just scroll down, if you look, even with the rising interest rates, now this will change next month, but a mortgage payment at 10% is still cheaper than rent, and that has been the case for the past few years now, since it did obviously change hands or change over, should I say, when interest rates really did spike. Right, on to Zoopla. So Zoopla reported, let's just zoom in on that. Zoopla reported 1.3% house price growth last month. As I said, modest house price growth. Change in buyer inquiries down 13% on a year ago. And then change in sales agreed versus a year ago down 2%. So you can see that here. This is a really good sort of chart to be looking at. So you can see as the months have gone on, buyer demand has reduced, sales agreed has reduced. Now, whilst buyer demand has reduced, there has still been sales agreed. As I said earlier, it shows that there is definitely still buyers in the market, but it's the committed ones that need to move that are making sales happen. And they're probably the ones who have mortgage offers at the lower interest rates as well. And if we look at this interesting graphic here, um, touch on that. Sorry, average mortgage rate have risen by about zero point 0.4 percentage points in recent weeks, with many sub 4% deals withdrawn as financial markets adjust to expectations of higher inflation. So what we're seeing now is average mortgage rates with five in front of it. The psychological positivity of them having fours in front of it have gone. And then the lowest mortgage rates that had threes in front of them now have fours in front of them. Those are real psychological factors there. Whilst it doesn't make too much of a difference to a monthly repayment, it does impact on the buyer psychology. So fewer active buyers in Q1, but enough serious movers to support sales agreed, as I said. And as I again have already touched on, market dropped down when we had the mini budget. We then had the rebound as mortgage rates fell and the stamp duty deadline. We then had a little bit of uncertainty over the autumn budget. And then we've had obviously the global events with the Middle East conflict as well to contend with. 6% more properties for sale versus this time last year. So as Rightmove said, more stock in the market, which is going to impact time to sell, price reductions, and house price growth. And then, as I've said previously, there has been some house price growth, and you normally find in higher interest rate environments, the northern parts of the country and your Scotland, your Northern Ireland, your Wales are going to perform better than London and the south. So that is the Zoopla House Price Index. Onto the on the market sentiment index. These are quite rare to come out, but it's always interesting when they have their surveys done. So just going to touch on this paragraph here. So affordability confidence remains high for almost three-quarters of active buyers, and it's equal to that recorded in September 25, despite the autumn budget, geopolitical conflict, and potential interest rate and inflation rising. Confidence is in spite of an increased expectation of interest rates, of which 36% of general public surveyed are forecasting, and a higher proportion than property seekers from on the market, of which it was 25%. So it's showing that while sentiment has reduced in the market, people are anticipating what's going to happen. Maybe that person who could borrow X or could buy a property at Y is now saying, you know what, I still need or want to move. I now just need to reevaluate what my budget is. And it's important those conversations are being had by estate agents. And then we've got this bit here. How do people feel about the market and the economy? So whilst expectations around house price growth have moderated, it appears to reflect a more pragmatic outlook rather than a loss of confidence. Really good language there. And the latest PSI shows that 41% of respondents still expect house prices to rise over the next year. I wouldn't be surprised if there was very, very, very small house price growth, to be fair, with only a 10 percentage point drop compared to 6 months ago, and a growing proportion now anticipate stability, with 60%, start again, with 26% expecting prices to remain broadly the same, up from 21%. And then almost 15% believe prices will fall, suggesting most buyers and sellers are adjusting expectations rather than stepping away from the market altogether. And I think that's what the data has shown us as well. So crucially, it's not translating into inactivity. Nearly three-quarters of those who have property to sell expect to do so within the next 6 months, down by just 4% since September 25, with half anticipating a sale within 3 months. That continued momentum indicates that even amidst economic uncertainty and mixed signal on interest rates, sellers are remaining committed to progressing with their plans. Again, the data has shown that with a lack of withdrawals and more price reductions happening. So buyers and sellers appear increasingly comfortable operating within a more fluid environment, one where price growth may be modest and conditions changeable, where confidence in transacting remains intact. Again, if you look at the past half a dozen years, anyone who has sat on the sidelines and gone, maybe it's not the right time to move, just look at all the things that have happened. From even in, I talked about going back to like 2007, 2008, even in the last 5 years of COVID, double-digit inflation, rising interest rates from record low interest rates, stamp duty deadlines, war in Ukraine, war in the Middle East, interest rates rising again, like so many things happening on that. And an agent's responsibility right now is to be the calm in the storm, I would say. And then How long do people expect here in market? Timelines for buying, selling, and renting remain broadly consistent with last year, even with everything that's been going on. So, amongst the on the market property seekers that have property to sell, 37% expect an offer to be accepted within 3 months, and 36% within 3 to 6 months. Buyers most commonly anticipate 3 to 6 months, whilst renters remain the most optimistic. A third expect to secure a tenancy within 3 months. Mortgages remain the most common source of funds for a new property. It's about 75% of the market, followed closely by personal savings and earnings. Many buyers will also rely on proceeds from a recent sale, while smaller proportions expect to use inheritance or financial support from relatives. You've got the bank of mum and dad, and then you've got equity release from grandparents as well. In terms of those looking to move, just the last one going to touch on. Most common reason for moving remains a desire for a new location. Upsizing is more common among the general public than downsizing, whilst on the market respondents show the opposite pattern. Other motivations include moving close to family, bereavement, relationship changes, and health-related needs. So you're going to have the 4 Ds of moving, 3 Ds being death, divorce, debt, 50% of the market, always going to happen. And then the other D is the 50% of the market, which has a desire to move. So when you have your 1.25, 1.5 million transactions, that's where there's going to be a lot more desire moves. And then in the sub 1 million transactions, that's where it's going to be less of those desirable moves. It's going to be death, divorce, debt. It is figuring out where those moves are going to be. In terms of wanting to know who is most likely to transact, I have a few things up my sleeve that will help with that. So if there's anyone watching this who wants an idea on some quick hacks on how you can find properties that are likely to transact in the future, please do give me a shout. Right, let's move on to Nationwide. So in terms of Nationwide, what I'll just quickly run through here is if you look at the implied path of the bank rate, it has increased. So got in March, early March, there was a a lot a lot of predictions that the base rate was going to cut from 3.75 to 3.5. In the end, it remained at 3.75, and it was a unanimous vote 9-0. And I think that was the first time off the top of my head in over 4 years that that had happened. So I think that gives a clear indication of where the short term is going to be. We're not going to see any rate cuts. Some are now predicting in maybe a couple of rate rises by year end. But it'll be interesting to see on that. In terms of wanting to know more about interest rates, swap rates, gilts, the implied path of the bank rate, do go check out part one of my LinkedIn newsletter. It is a chunky read, but there's everything you need to know in terms of how the financial markets could impact the property market on that. Just on that point, again, you can see that swap rates have increased recently, which is where the lenders are pricing in their mortgages for the future. So that is going to impact buyers borrowing. And then you've got to bear in mind as well, there is going to be a significant amount of people coming off 5-year fixes this year. And in 2021, they would have been very, very, very nice deals. So not only is someone going to see a higher monthly payment, imagine if they're wanting to upsize and borrow a couple of £100 more, that's going to be challenging as well. So whilst those buyers will find their mortgage repayments more expensive, that's not to say they haven't had kids or got married or got new jobs and need to move home and upsize, just their budget might be impacted on that because of the buying power. Although having said that, the stress testing has been relaxed. And that ease on lending is boosting buying power and what someone can borrow. And then if you look at the first time buyer mortgage payments as a percentage of take home pay, see where the long run average here, typically a third of someone's take home pay. And then you can see the dots on the right hand side if interest rates go up a little bit, where that will move to. And if I scroll down, this is a good bit here from households weathering the storm. So the labour market has cooled in recent quarters. Unemployment's been rising towards the peak seen during the pandemic. However, this has largely been driven by people re-entering the labour force with employment levels holding up well. Moreover, household finances are solid. Household debt at its lowest level relative to income for 2 decades, and significant saving buffers accumulated in recent years. So hopefully this will help mitigate the additional pressures, though many are still recovering from the previous cost of living crisis. Vast majority of existing mortgage holders are protected from the immediate impact of higher interest rates, circa 90% are on fixed mortgages. Also, while swap rates have risen considerably, to date the increase is much less pronounced than that seen in the aftermath of a pandemic. Again, you'll see that in part one of my LinkedIn newsletter, but they are still getting to levels seen in late 23, early 24, as seen in the chart above. In terms of house price growth, you'll notice that their recent data from Nationwide shows that detached property saw the biggest percentage rise over the last 12 months, followed by terrace and semis, and then flats have actually seen a small year-on-year decline of 0.5%. So looking over the long term, flats have seen noticeably weaker growth in other property types. So for example, since the start of 2020, the price of typical flats increased by 15%, half the rise in the price of detached houses, which saw a 30% rise over that time. Just on that point there's some very interesting data from Rightmove recently, which you'll find on the Rightmove homepage, basically highlighting the gap between a first-time seller going to second stepper. It's over £100,000 gap between the two price points, and it's one of the highest on record since Rightmove been tracking it over the past 25 years. So there is a difficulty in that upsizing there as well, which will create more fluidity in the market. So try and help those movers because they are really, really important to the market. Those first time sellers are going to be selling to first time buyers. That's the start of chains, but the first time seller needs somewhere to go to. But it's important that you help them understand their finances, how much equity have they gained. Maybe they increase their mortgage from 25 to 30, 35, 40 years. Do they need to alter their budget? So there's some work to be done there for estate agents in this market. So in terms of house price growth, so March 26 at 277, so highest nationwide pricing. You can see how it has moved over the years. If I scroll down a bit further, you can see that a lot of the country is in blue, which is a positive. And then house price earning ratio, it is still running at a 25-year average. So what the media will like to do is when interest rates have risen, for example, they will say, right, that's the extra monthly payment. Let's times that by 12 and say how much more it would cost a year. If it then says £1,000, that sounds a lot worse. But if you work out on a daily basis, it might be a few quid a day, which is how estate agents should be presenting that to home movers. Right, Halifax House Price Index. So the latest one will come out in a few days. But in terms of this one, the Halifax House Price Index is at 300,000, up monthly, up quarterly, up annually, and that's edging up to another new high. Amanda Bryden at Halifax has said that the housing market has been built on a steady start to the year in February. Average prices rising by 0.3% following the increase of 0.8% in January. Annual growth has also picked up to 1.3%, and that's the strongest it's been for 4 months. Since the start of the year, average prices have increased by around £3,000. Latest figures suggest the market has regained some momentum after a softer end to 25. Whilst industry data for January shows a slight easing in new mortgage approvals, overall activity has continued to prove resilient. So some of this data is going to be dated now because this is being reported on before the conflict really kicked off in the Middle East. They do go on to say there's no doubt affordability remains stretched. That will continue to be the case. Supply is constrained and regional disparities persist. Those without family support, the path to home ownership feels particularly challenging. As I said, Bank of Mum and Dad release equity. Conditions have been gradually improving with easing interest rates and real wage growth helping to support buyer confidence. That is kind of getting wiped out though with everything that's been happening recently. Looking ahead, the geopolitical uncertainties are going to influence the outlook for inflation and the wider economy. Against that backdrop, markets now anticipating a more gradual path for interest rates reductions. Again, that's dated. We're now looking at maybe a couple to happen this year. And if realised the speed at which borrowing costs may be tempered, again, not looking to be the case. I'd strongly recommend checking the Rightmove average mortgage rates link on their website, suggests you what's happening with interest rates every day. Do keep an eye on swap rates. And then also looking at the email that comes through daily that I get from Money Facts when it comes to mortgages. So if you want any of that data or how to get it, if you want the links, do drop me a message and I'll happily share that with you because I would argue it's very, very important if you're helping someone navigate the property market, dealing with their most prized tax-free asset, buying or selling. I'd argue you should know how much it costs to borrow money when you're advising on it. Right, that is Halifax. Move on. So ESEB house price index. Zoom in on that. So national growth at 1.8%, but the momentum is led by Scotland, Wales, and the North, which I touched on earlier. Global uncertainty at risk. So the strong early year demand could be tested as we see with the geopolitical tensions, and if they escalate any further than they already have. The Middle East conflict has already added volatility to swap rates and slowing the pace of mortgage rate reductions. Again, I've touched on that. You can see here the huge house price growth that was had during COVID, then dropped off as interest rates rose amongst double-digit inflation, and then the market improved, and it looks like it's going to steady off. Key headlines here, modest house price growth, market stabilizing. And then if I look at this bit here, a key leading indicator to support that trend, mortgage valuation volumes in their system remains ahead of expectations, solid activity from both first-time buyers and movers. Historically, this level of valuation activity feeds through to completed sales over the next 2 to 3 months, suggesting the pipeline into late spring is actually strengthening. So that's really, really good to see. I'm just going to caveat on that here. So strengthening through the first 2 months of the year, supported by improving affordability. That's kind of gone backwards in the past month. Reduced rate volatility. It's actually increased. And then perhaps we had some buyers who've returned to market after delaying decisions from autumn, but is there now going to be ones who delay that even further? So we've got that to consider as well. And then this bit here is a good read. So budget stability, but heightened global uncertainty. Again, we keep going from one to another, one to another. It's like points of confidence, lacking confidence, confidence back, all over the place. Now, again, this data would have come out prior to the Bank of England voting to leave the base rate at 3.75% on 19th March. We've got the next meeting at the end of April where hopefully it will be a pause, but it might be a little bit tight on there might be a 5-4 split on reducing interest rates. Hopefully that's not the case. So they say here well, I'll read the whole thing actually. The housing market entered March on a relatively stable footing. That definitely was the case. But then the geopolitical tensions, the escalation in the Middle East have presented new risks. The Chancellor's spring forecast set out a steady outlook, and then the geopolitical risk has pushed up commodity prices, unsettled markets. We've now got higher gilt yields, increased swap rate volatility, and that's now created a more unpredictable lending environment than was expected earlier in the year. Reports suggest some lenders have increased rates over the past week. They definitely have over recent weeks. And we've also seen a significant number of products be removed as well. When you look at the increases in interest rates and product removals from the market, it is not as bad as what it was during 22, 23. Just to put that out there, and we got through that and came out the other side. The macro backdrop remains mixed. The OBR expects GDP to grow just over 1% in 2026 and forecasts a slightly higher unemployment rate than previously anticipated. That reflects the labour market gradually cooling after several years of tighter conditions rather than a sharp downturn. That's really good to know. For housing, underlying demand should remain supportive. There's definitely still buyers out there, but the market remains very, very, very sensitive to deterioration in household confidence, and that's why we're in such a price-sensitive market, particularly amongst borrowers relying on higher loan-to-income multiples. So Activity strengthening, prices were rising modestly, affordability patterns were remaining a dominant driver of performance across the country. The key question now for spring is whether buyer demand can stay resilient enough to offset the continued softness. So, home.co.uk. So scroll down on this. So they are reporting new instruction levels slightly down year on year. Time on market has increased by 6 days versus a year and is at a 5-year high. Stock levels are actually down month on month and year on year. So we haven't got an oversupply to the market. So if you look at the stock level analysis there, dropped off a cliff during COVID, then things shot up as people perhaps saw higher interest rates and needed to move home. Last time stock levels have been this high is 2013. So whether it's Zoopla, Home, Rightmove, the data I've collated, stock levels are the highest they've been in a decade, dozen years. Asking price trend. So you can see we obviously had a lot of growth during COVID. It's then been a bit up and down in recent years. And it's pretty steady here. February saw a 0.6% change. And then you've got time on market analysis down here. So again, a lot higher than what it was during the COVID market. And then market turnover, again, you'll see where things went a bit peaked on as interest rates rose. You've obviously got COVID market, should I say, as well there. But things have been pretty steady over the past couple of years. And when you look at the day to day, pretty similar to pre-pandemic levels. Right. Last but not least, headline statistics. This is a UK house price index from March, reporting on January data. So currently, the average UK house price, and this is on completed data in January, 268,000, up 1.3% annually and down 0.3% monthly. And if I go to this chart here, in January 2007, so you can see the market was going up and up and up. It peaked in September 2007 at 175. It then hit a low point in March 2009. So it had about 18 months of price reductions there. That would have obviously been a bitter pill to swallow for anyone who bought in late 2007. But if they held on to that asset all the way through to now, look at how much it would be worth, 100 grand more. If we then look at the vote to leave the EU around this sort of time, people predicted the market would crash. Look at where it went, it rose. Then we had COVID and people thought the market would crash. Look at what happened, it rose. Then we had the mini budget, things dropped off. As you can see, highs of 265 sort of level, dropped down to the 255 before then starting to rise back up. Went back down a little bit as interest rates rose again. And then you can see it's been pretty steady and risen a little bit in recent times. So it shows when you look at the long term, there's only one way house prices usually go. When I look at 70 years worth of nationwide house price data, typically 9 times out of 10, so 90% of the time, property prices will go up. So basically once a decade, you'll have a bit of a blip, and then things will go again. So that is my Q1 2026 UK property market update. Quite thorough this month because of everything that has been going on. I hope you have enjoyed watching and have found that valuable. If you've got any questions for me at all, please do reach out and you will see me in early May as I report on the April data. And that will be an interesting one to see how the ongoing conflicts in the Middle East impacts interest rates, buyer confidence, activity levels and house prices. And I will see you then.